Ladies and gentlemen, welcome to the fourth episode of Living Markets with Liberty Corporate Benefits, where I'm joined by John Taylor, an actuary and investment specialist at Liberty. John, welcome and thanks for joining us after what has been a tumultuous, bumpy month. How are you feeling?
Leon, yeah, it's been a rough ride, but I do feel vindicated that when I said the good times can't last forever, eventually I was proven right.
So I'm feeling excited because my predictions that I made at the start of the year, which were looking very dicey at the time, are starting to look quite attractive in that sense. I think I might
You
be
are
in
right.
the money
You are right.
on that one. So when we spoke last time, we spoke about a positive budget for South Africa. The fact that our stock markets, despite some of the challenges we face as a country, lack of economic growth, higher unemployment, and so on, the stock markets were defying gravity. And you're right, you said at some point in time it has to stop. And if you go back over history, the Mexican earthquakes, the financial crisis of 2007, there's always something that comes at some point in time and slaps us with reality.
Yep.
So explain to the audience, if you don't mind, what has now happened, because we've been experiencing literally, I've never seen volatility like this in our markets. In 30 years, I haven't seen a month where it's not just up and down, but it's up 2%, down 5%, up 3%. I mean, the levels of volatility are just incredibly high. So give us the reasons for all of this.
I wish I knew all of them, Leon, but happy to give a stab. So we entered into March with obviously the start of the United States and Israel starting attacks onto Iran. That was on Saturday, the 28th of February, actually. And when markets then opened on Monday, they then reacted to the fact that this was quite a widespread disruption in markets because Iran was retaliating on American air bases and naval bases across the Gulf, which kind of drew in financial centers like Dubai, Abu Dhabi, Doha into this conflict, among other countries. And it resulted in immediately a closure of airspace, uncertainty around where the war would go. The concern then obviously quickly moved to what would the impact be on particularly oil markets and gas markets. And while the impact was kind of limited at the outset, obviously concerns as to how things would escalate. And unfortunately, they did reach a point where they did escalate, and Iran then proceeded to close the Strait of Hormuz. That would become very, geography has improved enormously, because we now understand that somewhere around 20% of the world's oil and more than that of the world's gas has to pass by a ship through the Strait of Hormuz out of the Persian Gulf. So we've become acutely aware of this kind of strangle point or choke point in the world. And that has meant that oil prices have been extremely volatile. And that's kind of your starting point where you, based on the news flow, which is extremely binary, either the war is coming to a rapid end or it is going to persist for some time and the effects will persist for some time. And on the back of that, oil prices react, which means that there are knock-on implications in terms of how different economies and markets around the world are going to perceive those shocks.
So just to slow down a little bit there, and let's think about the average trustee, maybe even member trustee. What we're saying is that there's now a blockage in terms of the supply of oil.
Yes.
That means there's a greater demand in effect now for what is available, and therefore people are willing to pay more, and therefore the price goes up. So it's now gone up, what is it, to last I looked was about
107.
107, yeah. So from about 80 or whatever it was, what was its low?
I think it was at the beginning of the year, it was closer to 70.
So it's gone up to that level. Now, ultimately, that oil gets used in multiple different facets. So bring it home for me. Now, what does it mean for us now in any country, but particularly here in South Africa? How does it start impacting us as individuals and then flowing through to our stock market?
Yeah, 100%. So obviously, let's start with South Africa. South Africa is a net importer of fuel. We don't produce a lot of our own fuel here, and we don't even refine a lot of our own fuel here in South Africa anymore, unfortunately. So you do get this kind of supply kind of constraint. We're obviously subject to global oil markets and the pricing on that. And there's a bit of a double whammy effect because at the same time that your oil prices moved up in US dollars, and I think that's an important point when we say it's 70 or it's 110, we mean it's 110 US dollars a barrel. And at the same time, we've gone through this period over the last 2, 3 years where the rand has strengthened quite materially against the dollar, mostly because the dollar's been quite weak. And that has reversed out quite sharply over the course of March. So you have this double whammy effect that the oil price has moved up in dollars, but the rand has weakened against the dollar. And that's what's been kind of the key driver if you exclude fuel price levies, a big driver of why fuel prices, diesel prices have moved up in South Africa at the beginning of April.
Why has the rand weakened? What causes the rand to weaken given this war? Is it dollar strength or is it actual rand weakness for a particular reason?
I think it's more to do with dollar strength. I think there is a little bit of rand weakness and emerging market weakness in general, as there's a realization that South Africa and other oil importing nations do face a lot of uncertainty around the kind of supply and the price at which they can get that fuel into the country. So it is a bit of dollar strength. You can see that because things like the gold price have declined. Now, generally, in times of crisis and uncertainty, you expect the gold price to firm up. Now, I don't know how much it could have firmed up given just how expensive gold was at the outset here. But you have seen gold prices drop. And again, that's a function of has gold gotten cheaper or has the dollar simply gotten a bit stronger?
And so the petrol price now goes up, the diesel price goes up. The government comes to the table by dropping the fuel levy. I'm assuming, obviously, I mean, it's election year, so there's reasons in that respect, but also they're worried about inflation.
Yes,
And the
100%.
impact that it can have on inflation. So how does the government fund that? I'm assuming they're having to rob Peter to pay Paul on this one.
Exactly right. So you'll recall, Leon, if anyone goes back to the previous video, you'll recall that we said the national fiscus has benefited in terms of tax revenues on tailwinds of a stronger rand versus the dollar, on tailwinds of a lower oil price, and on a great gold price and precious metals kind of pricing, which meant super profits and therefore super taxes for National Treasury to take in from SARS. Guess what? Those tailwinds have all disappeared in one go altogether. And the risk now comes in, and why markets are behaving so badly is because there's now this inflation risk from the supply side that gets introduced into the system, where if your particularly diesel prices have shot up, and I mean, we've seen that they've gone up. I think it ended up after the fuel levies have been temporarily reduced by around 5 Rand, 6 Rand a litre. I mean, that's enormous. I mean, we're talking about a 20% increase in the diesel price. That is a core input into the price of food, of materials, and the like. So the transmission mechanism into food prices and the like is very clear, and consumables. And that does mean that consumers will come under pressure, and businesses know that will affect their ability to get that demand for goods that they're looking for.
So the broader impact on goods and services is because of the cost of production now goes up, be it through delivery costs or whatever it might be, as a result of the need to utilize diesel, petrol, whatever, oil or whatever it might be.
Yes,
so that has an upward impact on inflation.
Yeah.
So inflation is going to feel the impact thereof. And now we have an MPC meeting after having an expectation of 2 interest rate cuts, and they've had to hold it because of, again, that concern on inflation. Does this mean that we can forget about the 2 cuts, or is that still on the cards?
They certainly delayed. They certainly are pushed out by a meaningful amount of time. And even if everything goes back to an inverted commas normal, it will take a lot of time to recover a lot of that, and a lot of the pain is already in the system. So, I mean, a point maybe to make is the Gulf isn't the only place that can produce oil, and we know for a fact certain parts of the world, like in Nigeria, can produce oil, but generally at a higher price. Well, those higher prices are here, and it actually becomes meaningful to Nigerian oil producers to spin up production capacity. Okay, so there are substitutes. The 2 challenges you have there is it takes time to get that capacity up and running. That you don't just flip a switch and oil is coming out of a well. And at the same time, you might have the production capacity that's improved, but you're still sitting with a meaningful number of oil tankers on the wrong side of the Strait of Hormuz that are not able to transport oil from Lagos to a Cape Town, a Saldanha Bay, a Durban, for example. So that becomes your challenges just in terms of moving this oil and gas from A to B.
So the costs of goods go up, households can spend less, businesses can spend less. That means the demand for services and goods drops, in which case earnings have an impact, and therefore it impacts the share price. And that's why we're seeing corrections in that sense. Now, interest rate cuts could alleviate that, but then you put inflation seriously at risk. So there's a fine balancing act that needs to be found by the authorities.
Absolutely right. So you're in a kind of situation where, remember, and let's not cause panic, but into a recessionary kind of environment, you want to have the kind of space on interest rates that you can cut them. If you've already got lower interest rates, you run out of space to cut those rates. So that's something to keep in mind if we move into a recessionary type of environment, which you've just spoken to how kind of less kind of money to spend on fewer things actually becomes a bit of a challenge. So as a central bank, you want to keep some powder dry. So that's exactly why they're not going to cut rates. And then there is that inflationary risk that they are concerned about. The difficulty is you're using almost a demand side tool being interest rates to control a supply side problem, which is your cost of input goods into these things like oil and gas. So there are some kind of places where you get some compensatory effects in South Africa. I heard some discussion out of National Treasury around the fact that yes, you can expect less tax revenue to come out of things like your precious metals and that. But at the same time, coal prices have also risen in kind of tandem with your oil prices, and South Africa is a net exporter of those. So it's not all one-way traffic. There are some compensating levers, but on balance, unfortunately, we do expect goods and services to get more expensive.
It tells me that two things come to mind as I'm listening to all of this and thinking through it myself, is that the fundamentals can shift quickly because you're part of a global system. So where we were talking in the last episode about the fundamentals were in our favor, it didn't take much for those fundamentals to now move against us in that regard. And it exposes the weaknesses, if I could put it that way, of our economy not being as robust as either what it should be because of either maladministration or alternatively just maturity of the system. So for instance, the fact that we've let our rail network deteriorate means that we rely a lot more on road transport, and therefore this has possibly a more significant impact than what it would do otherwise.
No, spot on. I would put forward maybe a third reason why this is particularly hard on an open economy like South Africa, and that is that we've built our economy since 94 in such a way that we are quite an open economy. In other words, we benefited from a rising tide of globalization, open economies, lower tariffs, more trade, etc., etc. Where the kind of main focus we had then is on just trying to get beneficiation right. So in other words, not exporting raw materials and importing kind of finished products, but trying to improve that. And we failed dismally at trying to do that over the last 30 years. What then becomes a challenge is as the world has moved into a more isolated insular space where every country is acting in its own self-interest. And you remember Mark Carney, the Prime Minister of Canada, I think it was at Davos in January, giving a great speech around how middle powers in the world, like a Canada, have to live with the fact that they can no longer rely on their big brothers next door to them to kind of move ahead. And South Africa is caught in a space where we haven't built buffers against that kind of thing. So we are very exposed to oil price shocks. We're very exposed to trade disruptions. And I think that is something that we need to keep in mind, that the rest of the world is moving into a space where everybody's for themselves. There's a lot of self-sufficiency that's being built in and that countries are rapidly trying to build in. And South Africa is behind the curve on trying to get some of those isolation kind of together in place.
EBNet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channels by clicking the subscribe button below. Share this video with others you think will benefit from it, and give us thumbs up if you are enjoying the content. That way, you help us help you. Thank you from the team at EBNet. For more great content, please visit www.ebnet.co.za.
I must say I'm quite torn on the whole thing because I mean I'm not a fan of war, and rightfully so. But Iran was a dangerous nation, or is a dangerous nation. There's a lot of fundamentalism, and they do have a fair amount of power there. So that was concerning. And if Iran did sit with a nuclear weapon, I would be not nervous for us in South Africa, but I'll be nervous about the impact that could have worldwide, kind of thing. So America attacks, and you can almost go, okay, I get why. But what are the reasons, the real reasons, ultimately, in terms of it? And secondly, is this now isolating America because it is creating a lot of, I don't think of a kind word, turmoil with the normal allies that they have in Europe and the UK and so on? So will it result in a new world order? And then where does South Africa sit in that respect? And obviously we don't know the answers to all of that, but you hope that we are shrewd enough to keep our eyes open and play that game appropriately. And I'm not convinced from what I've seen. It's almost like we've taken a side and we're sitting on one side, and we better hope that one comes out. And I'm not certain that's the right side.
Yeah, I think, Leon, does the world order shift? Yes. As I said, I think the globalization theme is now unwinding and has been for some time. I mean, that's not a new thing. Since Trump's first presidency, we saw a lot of that starting to unravel. That's just persisted, and maybe at a greater pace in his second administration. You get things like his threats to pull out of NATO. And remember, he's made noise about NATO for many, many years. So South Africa is just one of many countries facing a realization that the relationships and the kind of guarantees that they had on security, on trade, and even on climate kind of measures, those have evaporated in the last couple of years. And you get, for example, the UK realizing that if it doesn't try to pull together a bit of a coalition to support in terms of defense, in terms of trade, they're a little bit isolated now. So I think South Africa does need to play a much more strategic international relations game than we have till now, and realize that the sands are shifting, but it's very difficult to not pick sides at this stage, just given how polarized the situation is.
Okay, so all of this has resulted in, just for the sake of our viewers, I just want to read out some stats. So the all share index was down for the month 10.5%. Resources down 16.5%, obviously coming off a very high base. Property down 11.4%. Financials slightly more robust, but down 9.8%. Bond markets, even that's down nearly 7%. Some of the worst shares, Implats 31%, Harmony, so all the gold mining shares 29%. I mean, these are massive shifts. On the other side of the coin, because of the oil price, Sasol up 55%. But then you look at that, but you've got to go back only 5 years to see that they're still down 50% on where, or even more on where they were at the time. The Rand now, where's the Rand? 17 something.
Correct, yeah. It's at around just under 17 Rand a dollar this morning.
So the MSCI in dollar, so the MSCI South Africa in dollar terms down 18.6, relative to other emerging markets down at 13.1. So we've taken a bit of a heavier knock in that respect. So this is material. Members are going to feel the impact of this on their investment returns. Luckily, portfolios are balanced and have exposure locally, internationally, across different asset classes and so on. But I was privy to a conversation at a board of trustees earlier this week where they had made a decision to implement a life stage basis across their pension fund. And what it meant was that the two, call it buckets of portfolios, a sort of a moderate balance type bucket, and then a more conservative low equity type bucket or absolute return type bucket. They needed to transition members from the one to the other. And there was a date set in terms of that transition. It's mistake number one. And they have now put the transition on hold in lieu of the markets picking up so that they don't lock in the losses from the month of March. So I sat listening to this and I thought to myself, ooh, that could be a long hold.
Yep.
So
Yep.
it's a catch-22, absolute catch-22. And I was really thinking to myself, no one's doing anything wrong in this discussion. But you really are, it's almost assuming, we'll move it when the markets improve. Now, those members that should be moving across into a more conservative profile, because obviously they're longer in the tooth than the others, they are now remaining heavily exposed, and there could be more downside. So how do you manage something like that? I mean, I've got an opinion which I'll share, but in that situation, if you're sitting there and you're advising this customer now, I just don't know what's right and what's wrong.
It's a difficult one. I mean, I recall similar discussions kind of in late March 2020. Markets have pulled off, and I mean, at this stage, we didn't know that markets would recover extremely quickly out of the kind of COVID crash. I mean, that's the benefit of hindsight now. The struggle you face is you are talking about strongly negative numbers in the month of March. And before I answer your question directly, keep in mind over the last 1 year, all of those things are still strongly positive. Over 5 years, they've still made good money. The JSE is up 15.7% year on year still over the last 5 years. Resources are even still up nearly 20% a year over the last 5 years. Even the Rand is 6.9% stronger today than it was a year ago. So we need to keep a little bit of perspective on those kind of moves and not react to knee jerks over 1 month where a lot of stuff has happened in that 1 month. And that's why, I mean, you raise an important point. Delaying a move because of market volatility, that call on when to move back in, or in this case, when to move people out, becomes so difficult to do, because you almost inevitably going to get it wrong. And it talks to the risks around market timing. And I wrote a bit of a thing recently for Pensions World on this exact topic ahead of the recent volatility.
Good publication, that, by the way.
A very good publication. And Leon, there, one of my key points was around most people time getting out of the market actually relatively well. What the people are horrible at is getting back into the market. In this case, it's almost the reverse scenario where you're wanting to kind of de-risk people. They've now faced a bit of a capital loss. We don't know, does April bring a bit of a rebound and then you can sell them out? When do you pull that trigger? Remembering also, when you're moving millions and even billions of rands of institutional money, you can't just take a snapshot at a point in time. These things take time to be in the market. Global assets take days to disinvest, that you still participate. I mean, there are ways in which a lot of people will simply say, phase the money. So in other words, move a little bit now, move a little bit at the end of April, move a little bit at the end of May. You know, it's not always the worst, what's the word I want to call it, compromise to do that, because you're not taking point risk, but it does prolong that risk that you're sitting with.
So this is where I'm going to challenge the thinking a little bit and throw out my idea. And I don't know if I'm right, but I don't know. I'm arrogant enough to say I think I am. So first of all, if you had the discussion with the same board of trustees and didn't show them the month of April, and exactly as you pointed out now, you showed them the 12-month picture, that would be, come on, make it happen. Because it's still showing positive returns and members have benefited, so off you go. But let's park that aside. So that's perspective in terms of it. I believe, and I suppose it's premised on the fact that did they communicate to the members, which I'm assuming they did, the fact that this change would take place to de-risk those, de-risk those members. Those members are now expecting to be de-risked. Okay, and there's a reason, based on that model that's been put in place, that you've chosen to do that. So as soon as you communicated to them that they're going to be de-risked and there's a point in time, that portfolio should have been hedged.
Yes.
And I think that's where it's ultimately gone wrong, because it shouldn't, 1 April is 1 April. It has to happen. The members are expectant thereof. Right.
Yeah.
That means you've got to manage the process so that you eliminate the risk of not being able to do that, or minimize it as much as possible. To me, that's where I feel there could have been better advice given.
Yeah. I think
Ultimately to the client.
you're absolutely right that as soon as members hear that they are going to be protected from a point in time, I think it's important that you don't make that too far out, that you bring that closer. And hedging is a nice way to bridge the gap between the kind of effective exposure now and actually moving the physical assets later. So I do think that's a nice way of doing it. The other key trick is keep that timeline very, very short in terms of your implementation. Members can always choose later to change. And that's something that I've learned through time is when you communicate changes to members, always remind them that this isn't now cast in stone. You have an ability to make choices later about your money. We're not forcing you to make a choice before that deadline date. You can always make a choice later.
I just worry what responsibility or liability even that the trustees now take, because what happens if, no one really expected Iran to draw in. We expected them to attack the military bases across the Middle East. That was
Yes. Yeah,
almost
that was a given.
that's going to happen. Okay, but not
Yeah.
to start shooting missiles into other metropolitan areas and stuff like that, and airports around the Middle East. So what happens if suddenly, I don't know, Pakistan weighs in and decides to also now become part of all of this? And it does escalate to a point that it becomes a far broader and more serious conflict. We could be sitting in negative markets for years if something like that happens. So now what happens? Those trustees have meant to have de-risked his members. Guys are going to start retiring through the process. So I've got to think through that more carefully in terms of what that liability is that they sit with in making that decision.
Yes, because they're saying we're waiting for things to recover, but how long is a piece of string? And perhaps the difficulty we have here is particularly if you are a new asset consultant, shall we say, in the field, you probably only remember the very quick recoveries in the market. Even a 2008 took a year to kind of come right. COVID was a few months, and we're all expecting that, markets have sped up. We've been told the cycles are quicker now. I don't know in the event of, as you say, a prolonged conflict, if the same rules are going to apply. So, yeah, a very difficult one for, I think, as a trustee to find yourself in.
I'll never ever forget what my first boss taught me. The markets are going to go up, the markets are going to go down. I can guarantee that. I just don't know when and by how much. Okay, so that's a given. And therefore, if you go back over time, defined benefit to defined contribution, you would hedge the client's assets so that you could implement on the defined date. That was set. Same in terms of defined contribution, all in one pot now moving into life staging or member choice or whatever. You would hedge the assets so that decisions could be made and you could implement on the date. So I think that's what failed. Well, maybe I shouldn't be so strong. That's where things weren't fully thought through in terms of this particular scenario. And I worry about the liability that sits with the trustees now, because they've been told, oh, not serious, just wait until the markets recover. And as soon as I heard that, I was like, beg your pardon.
So, Leon, that opens up a broader discussion then. You bring up defined benefit funds, and the actuary in me gets excited to talk about that. And I know a couple of people have spoken about this particular point. Are we again not framing benefits to members incorrectly? Because we're talking about that fixed rand amount and saying your share of fund or your equitable share, you're going to go, perhaps you sitting on a pot of R1 million, and now with the market movements, it's dropped to 950,000 today, okay, as an example. And that's an immediate loss that I'm feeling, okay. But in reality, if we kept on framing it in those defined benefit terms and saying, what does it mean for your actual income you're expecting to take at your retirement age, the impact is significantly lower at that point in time. And we explain some of these factors around the fact that, again, your retirement date is not the be all and end all. You can still move into annuity strategies like living annuities where you participate in the markets again. So I think it's partially a concern around optics, showing a member that there's been this unrealized loss on their money. But if we can get the message back to what is the benefit that you're actually wanting to take out, it might make for better, call it, behavior from all the stakeholders.
Gee, I think you've hit the nail on the head, because that was I felt uncomfortable. And I mean, the meeting had nothing to do with me. I was there for a different purpose, but
Yeah.
I felt uncomfortable because I was listening. It was just too one-dimensional. It was too, oh, look what's happened to the markets. We should wait.
Yes.
And so to me, rather, we'll maybe show some historical analysis of generally how long you might have to wait, but then also show, but guys, please be aware that it could take longer. Look at this example or whatever. But at the end of the day, you're spot on. If you look at it in the context of what this ultimately means, what the past month means in terms of the end retirement, it's not massive. So
even for somebody much closer to retirement, potentially.
So is it therefore, if you looked at it from that perspective, you would say, well, it's okay that we lock in that loss just on those guys. Why? Because it's actually equally important to de-risk them further. I felt that the level of advice was lacking in the whole thing. Luckily, I didn't put up my hand and raise it. Anyway, John, listen, thank you very much. It's I think what it does tell me is this is when consultants and advisors are not just important, but the way they earn their keep.
Yes.
And a significant part of that job is to be the psychologist in the room.
Yes.
And to help people work through the emotions and so on. And that a psychologist never tells you one answer. They help you work through the permutations so that you can make the choice that best suits you. And that to me is the skill of an advisor or a consultant at the end of the day. So I leave that with the audience, and I challenge again, as I have been doing a lot lately, the asset consulting community to step up and do a better job.
100% agree now.
Have a good one. We'll chat again next month, and hopefully that fund has been able to implement their member choice.
I look forward to hearing.
Okay, all the best. Keep well. Cheers.
At Liberty Corporate Benefits, we believe that better benefits are better for business. That's why our holistic employee benefits give your employees financial security and lifestyle stability, freeing them up to be their best selves at work. With satisfied, engaged employees, productivity shoots up, workplace errors and loss decrease, absenteeism and presenteeism are reduced, and you attract and retain the best and brightest talent. After all, if you take care of your people, they'll take care of your business. Our brilliant basics are the non-negotiables that explain why more companies choose us than any other for employee benefits. Our employee benefits are easy and flexible, personal and relevant, and resource-backed, with investment solutions designed to help your employees retire comfortably. Comprehensive cover that protects your employees and their families. Financial literacy initiatives to help your employees make the most of their money. And a range of value-added services for holistic care and support. We make it easy to take care of your people and prove that employee benefits can also be employer benefits. Speak to us about getting the benefit advantage. Liberty Corporate Benefits.